Hello, fellow traders. It is TheRumpledOne coming to you Monday, March the 14th. The year's 2022. Let's talk trading. Trading Better, Part 7. These videos are for educational purposes only. Your results may differ from mine. Okay, so we've been talking about trading better all month. I read something, I think it was last week. I had nothing to do with trading, but it definitely applies to trading, and it has to do with expectations and then what you do to yourself when expectations aren't met. And it basically gets down to how you look at things. And they said what usually happens is either our expectations aren't met or they're not met to a certain degree. So we go through life and possibly through trading where we say, that's not good or it's not good enough. So, in trading, I don't know how many different methods and modified methods and spin-off methods there are out there. I talk about horizontal lines. You draw a horizontal line, you trade away from the line or towards the line, and you just keep it real simple. But the thing is, sometimes it might only produce a pip or two. And some people say, well, that's not good enough. Walmart likes to say, hey, you got one or two more pips than you had, when you started the day. Then it's like, shut up, be happy. Um, and that's just how it is. I mean, sometimes instead of being able to take one or two pips, you have a stop loss. So you say that was no good. And then a lot of people just want to throw that system out. But I guess what's happening is your focus is too narrow and your perspective is too narrow. Um, I guess you have to think of it almost like call it a long journey, because if you're lifting weights, you don't expect to go out there and lift 500 pounds the first day. You're gonna have to start closer to 50 or maybe even 5. You might not ever even reach 500. That's probably not realistic. I mean, it's not that you can't do it, but chances are probably not going to see that. So you have to have realistic expectations and manage them, because trading better is so much more about you managing, your expectations, what you do, what you don't do, than it is about the method or what's on the chart. I mean, we look at these charts pretty much every day. We can look at a monthly chart, we can look at a minute chart, and we can see what price has done. But the thing is, that's what it's done. It might do it again, it might not. I mean, we can analyze these charts to death. But as I've mentioned, probably ad nauseum, once you put the trade on, all this goes out the window. It pretty much does. A lot of people will tell you, traders will tell you, don't look at, the money, don't focus on the money, focus on, the chart. But you see, that's not quite 100% accurate. What you have to focus on is your risk management, your money management, and what's going on in the chart. So if your trade is up a couple of pips and it starts to go the other way, maybe you stop out and re-enter. Maybe you even re-enter at a better price. Because if it goes against you and keeps going against you and hits your full stop, well, that's a loss that could have been avoided. And so what you'll have to do is you'll have to keep track. Some people would call it a trading journal. But sometimes you can just use a simple, hash or tick um, scoring sheet, um, where it's like, you know, did I enter the trade properly? Was it a quote unquote perfect entry? Did I miss by a couple of points? Was I a couple seconds too late? What was it that I did or didn't do that caused my entry not to be quote unquote perfect? But that's the focus on you, not the chart. That's the focus on you. And so many traders, they fall for that Ferrari Lamborghini ad, with the latest and greatest indicator, the best trend indicator ever, or whatever that somebody's touting, some new way to analyze the market, neural networks, or whatever clickbait name they can come up with to get you to click and hopefully separate you from your hard-earned money. So, they can sell you a book, a course, an indicator, a system, whatever. But the reality is, if you just focus on those three things, um, you know, that method, because chances are the method that's only a part of it, because you can pretty much trade any method so long as the money management's there, and your brain management is there, and you're employing, your risk. You could literally flip a coin. I think I've proved that over the years. I think I did that with the Einstein lines. I did it with random lines. Um, But it's all about the money management. It's all about your brain management. It's all about trade execution. And so trading better means you're going to have to change when you think about it. If you want to be better at anything, you're going to have to change. Because if you stay the same, you're not going to get better. And that's like a cold, you know, bucket of ice water being dumped on you when it finally hits you. Because it's all about you. You guys know what I say at the end of these videos. So it's just something that maybe you're just going to have to sit down, whether or not you do it in front of a mirror, that doesn't really matter, but you're going to have to sit down, take some notes on what you have to do to trade better. You're going to have to look at what you're doing, how you're doing it, and figure out what you have to do different to trade better. Possibly, maybe you might have to change your method. I doubt it. I mean, even if you're doing squiggly line crossovers, you guys know how I like to tease about that. But the reality is, you can use squiggly lines and make money. But it's not the squiggly lines that's making you money. They're only providing a suggestion. You see that, what? The MA20 cross above the 50, or the MA5 cross above the MA200 or something like that, and you take the trade. Well, maybe it pays off that time, maybe it doesn't. Doesn't matter, because you might be taking it because it's a crossover. I might be taking the same trade at the same time because it crossed the horizontal line that I had drawn on the chart, or an indicator plotted on the chart for me. So, as I've stated before, that entry method, the reason you enter doesn't matter. And so once you put that trade on, if the market smiles upon you, you'll have an opportunity to take profit. But that's all the market's going to give you, is the opportunity to take profit. You yourself have to take that profit. Then after that profit happens, you take it, say you take 5 pips. If it then runs another 10, now all of a sudden those 5 pips aren't good enough and you put yourself into a tailspin. Or maybe you don't get an opportunity to even take 1 pip and it hits your stop loss, or maybe you cut it short. Like Walmart, I think his stop loss is at 10, his hard stop, but if he's down 7 or down 5 and he doesn't see the trade turning his way, he'll exit. And that's just part of trading. You can't think that each trade has to be a winner. You can't think that that trade's going to be do or die, because if it is, then you've done something wrong. You've really gotten off the path. You really would have to say, my trading plan probably needs some adjustment. So here we're looking at the weekly. As I mentioned in last night's video, we have these 3 missed pivots in a row, weekly pivots so far. The week just started, so this one's only missed if we end the week and it doesn't get hit. But I was saying I'd really be looking to take out this pivot sometime this week. I could be wrong, but we're now 28 pips above the weekly open. And I think when I made the video last night, we were, this was the week was red at the time. But you see, we're 53 pips off the bottom now. And if I remember correctly, we had filled the gap, but you see we got 1, 2, 3, 4, 5 that haven't filled the gap yet. We're still putting in that weekly range, and we're about, 70 pips, 69, 70 pips of range at the moment. We broke through the wick zone the previous day, both sides. We'll show that in a moment. 460 pips off the yearly low. As you can see here, the day, week, month, year low, 56 pips off of. Inside bar action, still most of the action's on monthlies. You can see we're so far away here. We won't have an inside bar today either. 69 pip range. We've got 8 pairs over 100 in range. Something to note, the new beast, the pound New Zealand, has been lagging the old beast, the pound yen. But I think that has to do with the yen and the dollar being safe havens for money, because of what's going on over in Europe. We can see the buy zone once again produced or gave you an opportunity to take pips. I mean, here's a perfect example. Could have exited somewhere up here. If you didn't, it may have taken you all the way back down to your entry. It's not the market's fault. It's just the market's just doing what the market does. You can see here price just came back and covered, so must be a lot of buyers here. And if you look real quickly, you can see here when price was here, it created a huge imbalance and they moved it back down, pretty much closed that imbalance. And we talked about imbalance last year. So there's a few videos on imbalance if you're not familiar with the term. But basically, when you have, say, this candle here and then this candle here, you see how this low is way above this high. This area here is an imbalance. And you can see here, price came back, filled that imbalance, and then took off. So here, price came back, filled that imbalance, and then took off again. And it works both ways. So you can see here, there was that selling imbalance, and then price came back into that zone, dropped again, but now you can see here, it had covered it earlier. Just, something to look at on the chart. So, fellow traders, I know that might be a harsh way to start Monday, me dumping that cold water on you, but you just have to remember it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One.